down over 16%, fallen about 18%.
The worst day on Wall Street.
So horrible.
China has identified the cause of the mysterious new virus.
Coronavirus.
Coronavirus. The first U.S. case has been detected.
We will be suspending all travel from Europe.
Death lockdowns. By the beginning of 2020, COVID-19 had spread widely in China and then to Europe, notably Italy and the US. The COVID-19 pandemic is the most impactful since the Spanish flu in 1918. The COVID-19 recession was an economic recession of 2020. The global stock market experienced a painful crash. It was a heavy blow to economic activities worldwide. In the first 3 months of 2020, the G20 economies fell 3.4%. On February 24, the Dow Jones and S&P 500 tumbled 11 to 12%, making the biggest weekly decline to occur since the financial crisis of 2008. March 16, 2020 was the day COVID-19 got real for investors. The Dow Jones dropped 12%, the second biggest percentage loss post-World War II. June 2020, the International Labour Organization estimated that 400 million full-time jobs were lost across the world. Income earned by workers globally fell 10% in the first 9 months of 2020, which is an over 3.5 trillion loss. The lockdowns resulted in collapse of various industries, especially those that provide in-person services, including retail stores, restaurants, entertainment venues, and museums and more, which put major pressure on banks, impacted credit market. This caused a stock market crash. Congress and the Feds stepped in. Interest rates were cut to near zero and a 2.3 trillion fiscal rescue package was launched, providing life support to markets, businesses, households, and local governments. By November 2020, the US markets finally returned to normal levels. The Dow Jones gained 6.6%, S&P 500 gained 15.6%. Trump, who was the president at the time, signed the largest federal stimulus package in history, payments of up to $1,200 each to millions of Americans, with additional payments of $500 per child. One main lesson from the coronavirus was the dependence of major economies on some inputs produced only or mainly in other countries is very risky. Market crashes typically happen without warning, but there is one question: when will the next market crash happen? Public companies sell their stock through stock market exchanges like the New York Stock Exchange. As an investor, you purchase a stock you think will go up in value. If that happens, the company's stock increases in value and you make a profit. If it goes the other way, you will lose money. These are some of the major market crashes we're going to cover in this video. But first, what is the difference between a market crash and a market correction? The stock market corrections take people by surprise and they happen more regularly. In investing, a correction is a decline of 10% or more. Now, whenever a market crash happens, people do one thing: panic selling. At that moment, this is the only logical thing to do for a lot of people. If you own shares of a company and you saw the prices dropping and other people are selling, you may decide to sell your stocks too in order to get some money out before it drops to the bottom and you lose all your money. Well, the problem is when a huge number of people do it, the stock crashes and will be worthless. This causes share prices to dive deep down. There will be fear and panic all over the market, which will prompt more people to sell their shares. This is one of the many reasons that increases the effects of the stock market crash. The crash will affect the life savings of many people who had never invested in the stock market. Banks go bankrupt, people can't buy houses, and unemployment dominates every conversation. The stock market, the most fascinating place to gain and lose wealth. The question is, do you always have to lose? The godfather of Wall Street, Warren Buffett, has been known to capitalize on market declines. The worst news to wake up to as an investor who owns a stock is a stock market crash. When the stocks you bought aren't valued at their buying price, one thing you should never do is sell your stocks at a loss. If you react by selling your your stocks at a loss, it further worsens the crash. As you are at a loss, logically you will think about reducing your spending, but instead, you should hold. Whenever you hear the New York Stock Exchange, the crowded trading floors come to mind. The Wall Street crash of 1929 was the most devastating stock market crash in the history of the United States, taking into consideration the full extent and duration of its after effects. When share prices of the New York Stock Exchange collapsed, the fall of share prices on October 24th and 29th of 1929 had a huge effect on all financial markets. Historians still debate whether the 1929 crash sparked the Great Depression. Only 16% of American households were invested in the stock market within the United States during the period leading up to this depression. In 2021, according to Gallup, 56% of Americans owned a stock, based on polls conducted in April and July. This is similar to the average 55% recorded in both 2019 and 2020. Among the well-known causes of the period of wild speculation, those who had bought stocks on margin not only lost the value of their investment, they also owed money to the financial entities that had granted the loans for the stock purchases.
Smoot-Hawley, or the Tariff Act, ballooned into hundreds of tariffs affecting all countries that exported to the US.
The Smoot-Hawley Tariff Act has collected a very bad reputation.
The passage of the Smoot-Hawley Tariff Act turned a bad recession into a worldwide depression and forced it to run deeper and longer than a normal business cycle. America put tariffs on imports, which caused other countries to put tariffs on American exports, and business stagnated.
Today is Black Monday, the day the Dow dropped more than 500 points.
They're calling it the Monday Massacre.
Nobody even expected it to be down this much.
A day that would come to be known as Black Monday, biggest one-day percentage loss of all time.
Panic is the only way to describe what happened.
Most often referred as the second largest one-day percentage drop in the stock market history, it was indeed a Black Monday for the stock market. It took 2 years for the Dow to regain this loss. The crash had a global long-term effect, with major exchanges around the world falling by at least 20% by the end of October. The idea of using computer systems to engage in large-scale trading strategies was still relatively new to Wall Street. The consequences of a system capable of placing thousands of orders during a crash had never been tested. It was caused by a computer program, algorithmic trading, for trading large blocks of stocks or other financial assets while minimizing the market impacts of such trades. If you are wondering how safe algorithmic trading is today, it's safe when you have a proper understanding of the systems and trading strategies. Worldwide losses were estimated at $1.71 trillion. The severity of the crash sparked fears of extended economic instability or even a repeat of a Great Depression. The year 2000, the start of a new millennium, was beautiful, with no smartphones, no Facebook, no distractions, and there was the myth where a lot of people thought the world is going to end. The year 2000 is also when many people expected the Y2K computer pack to cause worldwide problems.
We're afraid of a massive technological collapse, a global shutdown because of Y2K.
Including the disruption of electricity, food delivery, banking systems, and transportation, leading to a complete breakdown in society. Some believe computers will misread the year 2000 for the year 1900 and essentially shut down. Planes would fall out of the sky, the banking industry would collapse when the clock struck midnight for the new millennium.
But then the clock struck midnight and nothing happened.
And life carried on. But there was a problem. The dot-com bubble, also known as the internet bubble, took place from 1998 until March 2000, and the bubble passed. Before the dot-com bubble crash, the values of internet-based stocks rose sharply. Nasdaq surged from 1,000 points in 1995 to more than 5,000 in the year 2000. Chip maker Qualcomm saw its stocks increase more than 2,500%, fueled by speculation and encouraged the investment in technology. Many investors were willing to overlook traditional metrics such as price-earning ratio, which is the ratio used for valuing companies to find out whether they are overvalued or undervalued. Many investors focused on the wrong metrics, such as traffic growth to their websites, propelled by the startup companies. Low interest rates in 1998 helped drive up the amount of capital invested into dot-com companies. Before we answer that, let's go back a little. In the year 2000, there was approximately 17 million websites, which meant the technology sector was growing fast. The dot-com companies wanted to take advantage of this. The dot-com crash was triggered by the rise and fall of technology stocks and by speculation in improving internet stocks. The bubble intensified as key players such as investment banks and venture capital firms changed their own rules to take advantage of the public excitement. They poured money into the sector, driving up the valuation of every company with .com in its name. The bubble ultimately passed, leaving many investors facing huge losses. The dot-com bubble crash resulted in sell-off of stocks. The crash also resulted in massive layoffs in the technology sector. It was a pricey mistake investors ignored. Despite all this, only few companies with the right timing or deep enough pockets survived, the likes of Amazon and eBay. According to Fox, Bezos' biographer Brad Stone explained it in his 2013 book how close Amazon came to going bankrupt in 2000. Warren Jensen, the new chief financial officer from Delta, decided that the company needed a stronger cash position. Ruth Porat, co-head of Morgan Stanley Global Technology Group, advised him to tap into the European market, and so in February, Amazon sold 672 million in convertible bonds to overseas investors. The deal was completed just a month before the crash of the stock market, after which it became exceedingly difficult for any company to raise money. Without that cushion, Amazon would almost have been affected by the market crash. The dot-com crash also did help Amazon, since it wiped out many of its potential rivals, leaving Amazon and eBay as the only e-commerce players in the field. The dot-com bubble crash wasn't a total curse to Amazon after all. However, the company wasn't immune to the dot-com bubble collapse either. Amazon stocks tumbled from 100 to 9 a share.
Here, a loss of 37 points or so.
We're down over 16%.
Dow at the same time has fallen about 18%. The stock market is now down 21%.
We're now down 43%.
The financial crisis of 2008 was the worst disaster since the 1930s Great Depression. The US unemployment rate peaked at 10% in October 2009, the highest rate since 1983 and roughly twice the pre-crisis rate. The 2008 financial crisis has similarities to the 1929 stock market crash. Both involved reckless speculation, loose credit, and too much debt in asset markets. The foundation of the global financial crisis was built on the back of the housing market bubble that began to form in 2007. Banks and lending institutions offered low interest rates on mortgage and encouraged many homeowners to take out loans they couldn't afford. In September 2008, one 50-year-old investment bank collapsed.
Lehman Brothers is going bankrupt. Difficult day to face for Lehman's thousands of shareholders.
This developed into a full-fledged international banking crisis. The financial crisis of 2008 wiped out nearly $8 trillion in value between late 2007 and 2009. Big banks, including JP Morgan, Chase, Goldman Sachs, Bank of America, and Morgan Stanley, they took the bailout money, repaid it to the government, and emerged bigger than ever after the recession. The online banking market fully shut down due to shortage of cash and the widespread fear of the unknown among the banks. At the end of 2000, all the world's major financial economies were either in or fighting to stay out of recession. The Wall Street bailout package proved in the first week of October 2008 it got the economy moving again. The investments in the banks were fully recouped by the government, and the passage of the bailout package stabilized the stock markets. High risk doesn't always equal to high profits. The financial crisis showed us that no stock or industry is completely immune, and diversifying your portfolio can save you in crash time, which means don't put all your eggs in one basket. The price movements of stocks are based on several factors. More importantly, don't get tempted to sell your investments. When the market goes down, remember the golden rule of the stock market: the market will always bounce back. Thank you for watching.